All right, Peter, I'm going live. All right, everybody, welcome to our live monthly market update. My name is John Pasalis, president broker at Realosophy Realty. Thank you again for joining us. I like to do these, these monthly updates just to kind of give everyone a look at what's happening. I mean, we actually started these originally for our clients to kind of just give an overview of what we're seeing or what I'm seeing in the market, the latest trends that kind of impact them. This is not meant to be a forecast of where the market's going 6 or 12 months from now, but really just trying to make sense of the dynamics we're seeing on the ground now and some of the trends that might impact things in the months ahead. So on that note, we're going to, these are some of the things we're going to be kind of covering this month. I'm going to chat a little bit about some of the latest trends in the housing market. I'm going to talk again a little bit about, because I've been seeing some agents commenting on understanding the trends in the market, whether it matters if, more homes are getting bidding wars, selling for over asking, all of these types of things. I mean, I think it matters. Some agents think all of this data is irrelevant. And I'm going to try to unpack why I tend to disagree with them. We're going to have David LaRocque join us, who's been joining us for the past few months on our live update to give us his take on some of the trends that he's seeing in the market, in the mortgage market. And then Peter Carlos from our brokers chat a little bit about what he's seeing on the ground in the rental market as well. On that note, as always, anyone who has any specific questions, you can always send me an email at askjohn@movesmartly.com. If you're interested in booking a consult as a buyer or seller, you can just go to movesmartly.com/meet-john, and we can obviously talk about specifics in more detail. But of course, anyone who has questions can post them in the chat. I'll be keeping an eye on them along with Peter. Urmi can't join us today. So please post them in the chat and we'll do our best to kind of answer the questions as they come in today's episodes. Definitely. So we're going to try to answer some of those questions. So, following up on sort of a trend that I highlighted last month, whether Toronto's housing market is in fact heating up or becoming more competitive. And, I tend to see a lot of people in the industry or commenters or, housing bears who focus on, sales. And sales, if we look at them, are actually very close to a 20+ year low. And if we look at this chart, we'll see that sales for the month of February is what I'm referring to, are unbelievably low. I mean, the last time they were this low, quite frankly, was just after the financial crisis, and we haven't really seen sales volumes this low since 2009. But I think the more important trend that has been impacting sort of the balance between the supply and demand and the competition in the market is the fact that listings also remain quite low. So if we look at the number of new listings coming on the market for the month of February, they're actually at a 20-year low. The last time they were this low actually was in the year 2000, was actually just below that. But since then, they haven't been this low. And, I think of course, the one important metric that we're seeing with our clients on the ground who are looking at buying a home, and there's just nothing to look at. Like, there's just very few homes hitting the market across the GTA. It's not just one region. I mean, low rise, I'd say, is a bigger issue than condominiums. And the question, of course, is why are new listings so low? And I think there's probably a couple of reasons. I mean, for starters, people who are selling are oftentimes buying as well, right? And very few people are upsizing to bigger homes. And that is, of course, or downsizing in some cases, and that's keeping some inventory off of the market. So that's obviously impacting both sales and new listings. But on the other hand, I think we're starting to see, which is very interesting, we're not seeing a ton of distress in the market yet, which is what one thing a lot of people were expecting to start building. And again, distress doesn't happen overnight. It's not like, banks all of a sudden start foreclosing on tens of thousands of homes. Usually distress, builds up gradually, before someone loses their home. they try to list it on the MLS to try to exit that property, whether it's an investment or their home, if they need to, on their own terms. And we're not seeing that yet. And one of the reasons is that, when I wrote about this in a report and I've been talking about it on Twitter, is that the banks have been very accommodating when it comes to their mortgage rules. We heard about this term called the trigger rate, in the fall market. And the trigger rate is basically the rate where if you have a variable rate mortgage, at what point or what interest rate do we have to hit where your mortgage payment no longer covers even the interest on your mortgage? And I should expand and say that this only impacts people who's on variable rate mortgages with fixed payments. Scotiabank is the only big bank where your payment actually increases as the interest rate increases. All the other banks don't do that. And what some of the banks have been doing is just working with borrowers and not requiring them to increase their payment. And CIBC actually came out and said that 20% of their mortgages now, the mortgage payment doesn't even cover the interest on the mortgage, which means the mortgage balance is growing. And again, that's the case for the most part of variable rate mortgage borrowers who are just not even keeping up with their interest payments. And then I posted some stats also on how amortization periods are growing. Again, so when you get a mortgage in Canada, the longest amortization is 30 years. But if you have a variable rate mortgage and interest rates are going up rapidly and you're not increasing your payment fast enough to keep up with that original amortization schedule, well, your amortization just gets pushed out further, right? Beyond 30 years. If you're not paying any of the principal down, your amortization is effectively infinite. Because you're never paying it down. But for the most part, it just gets pushed out to 35 or 40 or 45 years. And many of the big banks publish some statistics showing that the percentage of their mortgages now that have an amortization period of longer than 30 years. And for Bank of Montreal is 32%, CIBC 30%, TD 29%, and RBC 25%. So again, these are, for the most part, people on variable rate mortgages who just have not increased their payments enough to to keep up with their original amortization schedule. Now, these are short-term dynamics. Again, we haven't seen the full effects of rates, because eventually, even if you're on that type of a mortgage, at some point, you're going to have to renew your mortgage at today's rates and at today's payments. You cannot renew with a negative amortization where your payment doesn't cover your interest. Like, that's not going to be an option. So over time, over the next 12 months, we're going to see more and more people needing to renew at higher rates. And this is where I think it's going to be interesting. And when we talk about, and I've talked about, I think David LaRocque and I last month talked about how we're still early in this cycle. Like we haven't felt the full impact of higher rates yet, because most people's mortgage payments haven't been impacted. And, the longer rates stay high, the more we're going to see people actually renewing at higher rates, and then we will maybe start to see a little bit more pressure.
You cannot make noise.
David, I think David's microphone's on.
Sorry, John.
I think that's kind of one of the things we're going to have to keep a close eye on. So the more important trend, I think, when we look at the imbalance in supply and demand, is really, I'm going to show kind of one stat I think is very important. When we look at, sorry, one second. When we look at the change between February and January, the number of sales have changed. So between February and January 2023, we saw 1,688 more homes sell in February versus January, basically, 2 months ago. But when we look at the increase in new listings, only 673 more homes got listed from January to February. So sales are outpacing new listings. And then Korea, the Canadian Realosophy Association, actually published statistics for the month of February. And they actually showed that when we adjust for seasonality, new listings actually fell from January to February, right? So when we have, almost 1,000 more homes sell than new listings hitting the market, what that's telling us is that a lot of buyers effectively in February bought the older listings that were just sitting on the market in January and were just waiting for a buyer. And what this effectively does is it pushes inventory levels down. And we've seen inventory levels plummet for houses and condos. I mean, houses now at the end or mid-March have about 1.5 months of inventory. Condos are just around two and a quarter or something like that. And again, this is a sign of the market becoming more competitive. Like low-rise inventory levels haven't been this low since around April. And similarly, condo inventory hasn't been this low around since around May. And I think this is the important thing I think a lot of people are missing. It's really this balance between the number of listings and the demand that is impacting the dynamics we're seeing on the ground right now, which is actually very competitive. You know, I shared this chart last month, and obviously you've refreshed the data, but the share of properties, especially low rise, where this is a bigger impact, of homes selling for more than the asking price keeps climbing, and it's at the highest level it's been at since the beginning of June. Now, you know, again, I think one thing I wanted to chat about is I've seen people kind of talk about how one person asked, is this statistic valid, the percentage of properties selling for over list, when the current realtor tactic is to list below market to create a bidding war? You know, and I saw some people in the industry argue that that this statistic is not valid at all. And, you know, if 75 to 80% of listings are listed, you know, 25% below market, the stat's a bit silly. And I'll tell you why I think this is a problematic view, especially for someone who works in the real estate industry. If we look at the percentage of properties that have sold over asking across the 5 regions in the GTA, and if we look at them, you know, what do the statistics look like for February? And then what do they look like over the previous 6 months? Like, have they changed over time? And how do they vary regionally? And if we do that, we can see a number of important trends. I mean, if we compare February of 2023 versus the previous 6 months, for all 5 regions, we're seeing way more homes selling for over asking is the first important trend. So if this is just a realtor tactic, I guess one question is, did realtors just wake up in February and decides to do this? Or is there something different about the markets today? And I would argue when you look at inventory levels, the market's more competitive today. But similarly, another way of looking at it is sort of looking at these regional differences. You know, when we look at the percentage of properties selling for over asking in a region like Peel, it's just over 20%, whereas Durham and York region are closer to 50%. Now, again, some realtors are going to say, well, that's irrelevant. It doesn't matter. I mean, I would argue that this is telling us that the markets in Durham, Real, and York are more competitive. It's not telling us that the realtors in Peel just haven't learned about this bidding war tactic and are ignorant. I mean, you know, and I think this really matters. I mean, the other, of course, trend is understanding that these dynamics change over time. And if we look at sort of the long-term trend of the property selling for over the list price, they have varied significantly over time. And again, this is not just due to realtors waking up one day and deciding to use this tactic and then one day falling asleep and forgetting that they could list low and sell for over asking. The reality is the over asking depends on the imbalance between supply and demand at any given point in time. And I think this is really important. And I'm not even going to talk about, we'll ignore from a buyer's perspective. And I think that's important. I'm going to focus on, you know, why this matters. And I'm going to stop sharing for now. Why this matters from a seller's perspective, right? So if we think about that chart that showed the regional differences and how it's changed over time, I mean, to me, it matters because if we're listing a home for sale, the pricing strategy we choose is a function of both when we are listing the type of home and the neighborhood trends that are driving sort of this imbalance between supply and demand. Meaning, you know, if we're listing in an area like Peel where far fewer homes are selling for over asking compared to York where it's far more common, our pricing strategy might differ. We're going to be a little bit more reluctant to list low with an offer date in an area where very few homes have successfully done that, for example. Whereas in areas like Markham, it's something like 60% of homes selling for over asking. So we're more confident. But on top of that, we're not just looking at the numbers. You know, if we're about to list a property for sale, we're going to look at what the neighbor just sold for down the street. And, on the surface, some agents might look at that and say, okay, they listed for $1 million, they got, 200 over asking. Well, let's follow the same strategy. But again, I think just looking at the statistics is a little bit misleading sometimes if we're not following the broader market trends, because sometimes I'll see or find that the market is slowing down just more broadly. And when we're doing that and we're about to list a property for sale, we don't just look at what the neighbor listed for and what they're sold for. We need to call the listing agent to find out what happened on their offer night, what happened with their showings. And you could get one of two reactions. You could get the listing agent saying it was unbelievably busy. There's a lineup of people. We had 20 offers. It was very competitive. There are a lot of people that want this type of home. And if that's the case, maybe you're more confident listing low with an offer date. But if a listing agent tells you that, the buyer's sentiment has changed, buyers are feeling more anxious, they didn't want to compete, and that listing agent says that they were lucky, they only got one offer on their offer night, but that buyer and agent knew the market value, so were willing to pay over asking anyways, well then, am I back? Peter, can you hear me okay now?
I can hear you, John.
All good.
All right, beautiful.
All good.
All right, guys. Sorry about the audio. The audio fell apart on me. I'm not sure what happened there. So that is a little bit about what we're seeing on the ground, why I think some of that data matters. And again, I think when we think about what the spring's probably going to look like over the next little while, we're probably going to see, I suspect, listings pick up a little bit. That's usually what happens. So I think this intense competition that we're seeing on the ground, if you're actively looking at buying, and again, what you might see on Twitter is very different if you're looking at buying homes. If you're looking at buying homes, it's a very difficult market because there's just not a lot to choose from. And I will say, I posted this on Twitter recently. I mean, what I've been seeing is I would not let the multiple offers throw you off. I mean, I've seen some sales that are ridiculous. But most of the sales more recently that I've been seeing, even though they get like 20 offers, have been selling for prices that are not overvalued. I mean, they're still expensive because house prices today are still very expensive. So take that with a grain of salt. But they're not selling, usually when a home gets 20 offers, it sells for a premium above the market value. And we're not seeing that. I'm not seeing that as much. I'm seeing more places now sell for kind of market value. And I think, again, part of that is just a constraint and a limitation on both the fact that prices are so high and it's unbelievably expensive relative to where rates are today. So I have a couple questions. One question here, John, do you see anything happening in the near term to drive prices lower? It looks like on the ground metrics suggest higher prices. Yeah, I mean, yeah, to be honest with you, I don't see anything in the near term. And again, because the market's just, I think it would take some time. We would need to see I think it would be a more gradual shift if we start to see inventory outpace sales. And to me, like, this is the important dynamic. I mean, I started the presentation showing you how sales were outpacing new listings. And I think for us to get to a market that's cooling down, we need to start seeing new listings increasing at a faster rate than sales, right? And when that happens, it doesn't mean prices are going to fall instantly. we might move to a more, what's likely going to happen if that starts happening is we move to a more balanced market where homes aren't getting 10 offers anymore, where, sellers are listing and taking offers anytime. Only 15% of homes are selling for over asking, like the really nice ones, but everything else is just sitting on the market. That is usually what happens. Like that's kind of what I would expect. And then if inventory continues to outpace, or if new listings continues to outpace sales, then yeah, we might see more downward pressure on prices. And like I talked about earlier, it's very possible, depending on that how the economic trends evolve over the next 9 to 12 months. I mean, there's so much volatility and uncertainty right now, and inflation and like the banking market. It's just like it's so impossible to predict. But and I tweeted this morning, I did an interview with the Toronto Star, and the journalist said, well, most economists are calling this the bottom, and after the first quarter we're past this. And they of course they say, well, what do you think? And I'm like, it's just so early. I mean, I don't know how someone can call this the bottom yet, when rates still look like they're going to stay high for longer, despite what the bond market's saying, which David will talk about. But it's still early, and I'm still a little bit cautious about calling the bottom. So I think we just need to keep an eye on how the market evolves over the next 6 to 12 months. All right. On that note, I'm going to someone commenting on my haircut, and I appreciate it. I'm going to ask David to join us. David LaRock, who is a mortgage broker who's been joining us over the past few months, talking about the latest trends. And again, I thought it'd be good to have him on again to chat about what he's seeing, because I feel like everything has changed in a month since we last spoke. So maybe, David, you can unpack some of the things that you've seen. I mean, even over the past week that have kind of impacted the mortgage market, the bond market, and obviously how that might play into the mortgage market.
Sure. Well, sometimes you get about 6 months worth of action in a week. And that's basically what we've had in the bond market. I wrote about this in my blog. Last week, the Bank of Canada issued its latest policy statement. As expected, they held their rate steady. They paused for the first time in 9 meetings. But they warned that they would continue raising rates if the data basically came in higher than expected, and made it clear that their bias, it's a conditional pause, conditional on the economic data unfolding as expected, and that their bias is still towards more hikes as opposed to cuts, because of course the market is anxiously awaiting cuts. Mm-hmm. So that was a bullish signal that should have pushed bond yields higher. We also got the latest Canadian employment report. And by the way, in her speech the day following the policy announcement, the Bank of Canada doesn't always do a press conference to accompany their policy announcement. This was one of the meetings where they don't do that. So they give a speech the next day. In this case, it was Deputy Governor Carolyn Rogers who gave a speech. And in that speech, they kind of outlined what the bank's current thinking is. And she mentioned specifically that productivity is low and wage growth is still too high, and that basically we're not getting back to 2% inflation until that changes. So Wednesday they didn't raise, but they said that they would raise if they had to. Thursday we got the speech from Deputy Governor Carolyn Rogers saying that they're worried about productivity and wages are still too expensive, still too high. We can't get back to 2% inflation if wages are still this high. Then on Friday we got the jobs report, and on top of our long-term average for job creation is about 10 to 15,000 jobs a month. In January, we got 150,000 new jobs, and that was after a huge December. And normally, when you get big surges like that, it would not be unusual to have some give back, a negative month. And we actually got 21,800 more jobs in February, so still an above average month for job creation. And wage growth accelerated and went back up to 5.4%. All of that then hugely bullish. Meanwhile, in the US, and we have to pay attention to the US market because Government of Canada bond yields piggyback on US Treasuries. Basically, if something happens in the US that pushes US Treasury yields higher, and something really bearish happens in Canada that should push our yields lower, 9 times out of 10 our yields are going higher because they're riding on the backs of US Treasury yields. Mm-hmm. On Wednesday, Fed Chair, U.S. Federal Reserve Chair Jerome Powell said, we now expect that the peak, we're going to have to raise rates to a higher peak than we had thought previously. So super bullish there. Then, instead of getting the 210,000 jobs the consensus expected, they got 335,000 jobs. And that was after a huge month the month before as well. And they're ripping along, and their average wage growth per month reaccelerated in the latest data for February. And we learned all that last week.
So let me just hit pause for a second, just unpack it, because we actually had a question about how the wage growth might impact housing. And from what you're saying is when wage growth is very strong, it really just kind of gives the Bank of Canada ammo to keep rates higher to cool wage growth, right?
Right. So when quick sidebar, when the pandemic hit, and inflation really started to take off for the first time. Most of the inflation we were seeing was in goods. And the example everyone uses is everybody was stuck at home, so people wanted Peloton bikes so that they could exercise at home, and the cost of Peloton bikes went up, and so did lots of other goods. Most of that inflation came from overseas. Mm-hmm. What's happened since the reopening and over the last 12 months is inflation has shifted from being primarily due to goods inflation, the price of goods, and primarily being driven by foreign factors, to now it's being driven by domestic price pressures. And most of the inflation we're seeing today is in the service sector. The number one cost in the service sector for almost every business is labor. So the Bank of Canada said, we're going to have to keep raising rates if inflation doesn't come down. And the thing that's driving inflation right now are service costs. And the biggest component of service costs are wages. So when wages, remember, the bank has said, we got to get all the way down. We got to get inflation all the way down to 2% before we can even think about rate cuts. Mm-hmm. And wage growth right now has been clipping along at 5% plus for the past 9 or 10 months. Mm-hmm. So what the bank has said and conceded is we really aren't going to get back to 2% inflation until wage growth slows considerably, and that means we see less job creation, and basically there's less of a mismatch between the demand for labor and the supply of labor. Mm-hmm. So basically, in a lot of the posts I've been writing, I've been saying inflation is going to be stickier than we expect. Anyone pricing in rate cuts this year, I think, is being too aggressive. I think anyone with a variable rate should be resigned to the fact that their rate probably isn't going to start to come down until sometime in 2024. That doesn't mean variable rates are a terrible idea, because if the Bank of Canada has to hold rates higher for longer, basically it has to do a lot of damage to our economic momentum. And when inflation does finally come back down, I think we're going to see a rapid series of rate cuts, and variable rates are going to get a lot cheaper. So it's not clear. Nobody should be certain of what's going to happen. It's not clear when that'll happen. And if you're in a variable rate today, starting out for 5 years, it's your average cost over 5 years that will determine whether or not you'll save money versus your 5-year fixed rate equivalents. In my blog, I say I think variable rates are an aggressive bet right now. It's not that I think anyone's crazy who takes one, but I think for conservative people who want a middle of the road safe pick, right now variable is not the thing. Right now, 3-year fixed rates or 5-year fixed rates are, in my opinion, much safer choices. And again, probably, you might not knock it out of the park, but you're not going to get slammed either. So, John, back to the last week, super bullish comments from the BOC and the Fed, stronger than expected employment reports again, upticks in average wage growth, showing that wages, far from slowing, are accelerating again. And then we get to Friday. And on Friday, Silicon Valley Bank goes down. And there's basically a financial event where stability risks really take over. And now, instead of everybody driving up bond yields because it looks like inflation is going to stay higher for longer, suddenly people are panicking. They don't care about the return on their capital. They care about the return of their capital. They want to get somewhere safe to make sure that they don't lose everything. And when there's a bank failure, there's an old expression, there's never just one cockroach. So the question is, rates have gone up. Now we're seeing weakness in the financial system where there was lots of it because rates were super low for a long time. How many other banks are going to fall? And will there be a domino effect because banks lend to other banks and we have a very interconnected financial system? Interestingly, in Europe, Credit Suisse started to wobble. That really scared markets. The other thing that freaked out markets a little is Silicon Valley Bank basically a whole bunch of banks had a chance to come in and look at their books and decide if they wanted to buy them at a bailout price. And nobody wanted to touch them. And that scares people too, because when the banks can open up the books and look at everything with a team full of due diligence people and nobody wants to buy it, that's again a signal that there's a lot of rot there. So that caused bond yields to plummet. Now, I'm getting emails today, and I got them Friday afternoon. A lot of my clients, they love following markets. They read my blog. They know what happened. They know what's happening with bond yields. And everybody's saying, "Is my rate going down? Yeah, I got approved at this rate. Bond yields are collapsing. Am I getting a better rate?" And I have to explain to people two things. Number one, lenders don't price in real time. So when there's a market event like this, they aren't just gonna drop their rates right away. For one, they want to see where the dust settles. And by the way, today bond yields have snapped back up and we're coming out of the trough that we were in. So we're not all the way back, but a lot of the plunge we saw on Friday is already back now, less than a week later. Okay. The other thing is, when you have a bond yield collapse because of concerns over financial stability, systemic risk, there's a risk premium that gets added to all the money being lent in the market. So lenders borrow the money that they turn around and lend out in mortgages, and they make their money off the spread between what it costs them to borrow at and the rates they lend out at. And when there's a systemic event like this and rates collapse, risk premiums go way up. So from a lender's perspective, they oftentimes aren't left better off on a net basis, or not better off by as much as people would think. So between waiting for the dust to settle and the fact that there are risk premiums that borrowers can't see beyond just the changing bond yields, those are reasons why nobody's rates have moved. And let's remember, if in another week, because Credit Suisse got bailed out yesterday, I think the Swiss central bank said that they would give them a liquidity injection. The Fed has basically stopped quantitative tightening now. They're injecting liquidity into their financial system to the tune of $2 trillion. So as these things happen, the market will normalize. I suspect bond yields will probably normalize in the next business day or two. And then we're back to where we were, with a super bullish BOC and Fed and crazy strong job reports. So we may well see the next change in mortgage rates be an increase when it comes, because with this, if markets are now satisfied that a lot of this systemic risk has been addressed, and we're not going to get wide-scale bank failures, and we're not going to get panic selling, we were in the midst of what probably would have been rate rises. So borrowers might be surprised. Everybody's saying, "Where's my rate cut?" Well, in another week, we may be back to where bond yields were trending up in response to all of the comments from the BOC and the Fed and the stronger employment data.
Okay, so I mean, you said a few great things that I think I'd like to unpack for people, just for clarity, and maybe you can make sure I'm on the right page. So the decline in bond yields that, for some people who are following this, what you're saying is really normally changes in bond yields are sort of an outlook about sort of the economy and interest rates and all of these things. But what you're saying is when they fell over the past week, it's really not about that. It's about people just trying to preserve their capital, like you said, where the return of capital is more important than the return on capital, right? Yeah. And this is what drove it. But what you're seeing or suggesting is that this, provided this financial risk that we're seeing is contained, that this is going to be a short-term event, that bond yields will eventually kind of pick up again, and we'll be at business as usual, which is rates are going to stay higher for longer. Is that kind of what you're saying, basically? Yeah,
this is a black swan, Mars hits Earth type event. So yeah. If Mars hits Earth, then we're all going to be wearing tinfoil hats and fighting over can openers. But assuming that this all, normalizes pretty quickly, which it seems like it's going to, we're back to where we were. John, just to explain in very basic terms, bond yields are a reflection of where people think inflation is going and how much return they're going to get. So if you buy a bond and the return on the bond is 5%, let's say you're an investor and you have $10,000 and you buy a bond that pays 5% for 10 grand. And a week later, you learn that inflation is going to be higher than expected. Well, inflation erodes your return. That 5% is the nominal rate that you get on that bond. But in reality, if inflation was going to be 2% and now it looks like it's going to be 3%, the yield on that bond will adjust for the fact, basically the price of the bond will go down, the yield will go up to reflect the fact that if you want the same return on your bond that you were going to get last week, now that inflation is going to be higher, the only way anyone would buy that bond is if you gave them a higher yield to compensate them for the diminished purchasing power, for basically the erosion that happens in purchasing power, or the erosion of your return on investment if inflation is going to be too high. So everything we saw last week from the BOC, the Fed, and the jobs reports should have pushed yields higher. Basically, it would have been in a normal week, it would have been interpreted as bullish signals that inflation is going to be stickier and higher than expected, and that rates may have to go, the BOC and the Fed may have to raise, but at the very least, bond market investors would say, hey, it looks like there's going to be either stickier inflation and higher inflation. So I want a higher yield. I want more return on my investment to compensate me for the fact that inflation's now going to be higher. That same guy who bought the bond for 10 grand the week before, knowing what he saw last week with all of that new information, would say that 5% yield that I took for my 10 grand this week, if I have 10 grand more a week later, now I want 5.5, because the 5 looks low based on the fact that all this new data is saying inflation is going to be higher. So that's what the bond market was doing. When yields turned the other way and they went through the floor, it wasn't people saying, we're going to have slower growth, inflation is going to come down more than expected. If we got a really weak jobs report, we might see a big drop in yields, and that would be reflective of a different outlook for the economy. In this case, the reason yields plunged wasn't because of a change in the economic outlook as far as our data and what the central banks were saying. It was simply people saying, I got to get safe, and sovereign bonds are a very safe place to be when stuff's hitting the fan. So it really became the normal dynamic changed, and it really became a matter of supply demand. Lots of demand for the safest assets you could buy in the market, safe haven assets, we call them, which sovereign bonds are, both US Treasuries and Government of Canada bonds. And people saying, forget everything else. I don't care about how much return I'm going to get. I couldn't care less what yield is. I just want to own government bonds, because if banks start failing like crazy, stuff can go to zero, and I need to be safe first and foremost. So that took over. But again, I don't think it'll last. And it looks from what's happening with the Government of Canada bond yields today that it's kind of sorting itself out.
Okay, so you in your post on Move Smartly, I think you mentioned that you are, or the market's pricing in another full potentially 100 basis point hike south of the border, the US Fed. And
not anymore.
Not anymore? Okay. So what?
The futures market is very volatile, John.
Okay.
It was pricing in a 75 basis points in hikes. It peaked at a 1%. It basically said that the Fed was going to go up another 0.75% to 1%. It was wavering around there. Now we're getting rate cuts priced in. Now they're saying the Fed's going to cut by 0.5% by the end of the year. Okay. It really is a bit of a ping pong ball. And again, I wouldn't put too much stock in that.
I see.
At the end of the day, John, I mean, my comments may not age well if we have a systemic collapse, right? If banks start failing like crazy, then we are getting rate cuts. But we shouldn't wish for that, because if we get rate cuts in that scenario, we're all going to be wearing tinfoil hats and fighting over can openers.
That's awesome. I don't know if we have any specific questions. We had one question saying, do you think there will be another hike soon due to inflation as well as US interest rates? So in Canada, I guess the question is, do we expect the Bank of Canada to hike maybe one more time this summer? And I know that was priced in before the collapse of the Silicon Valley Bank. I mean, I think there's, they're pricing in maybe like high likelihood at least of another rate hike. But what do you think is most likely now?
Well, again, the futures market is volatile at the best of times, and even more volatile now than normal. Look, the bank said that they were going to pause and allow time to assess the impact of all the rate hikes that they've made. Right? They've done a ton of tightening. The sharp series we've had 4.25% worth of rate hikes over a short period of time, and it takes up to 2 years before they exert their full impact on the economy. So the Bank of Canada has really loaded the gun, and they want to wait and see what the impact of all these rate hikes is. They have said they're going to pause to allow time to see what the impact of the rate hikes is. They've warned they'll raise if they have to, but they've also said it will take an accumulation of evidence to move them off the sidelines again. So whether it be a hike or a cut, it won't be one jobs report or, one piece of economic data. They really want to see an accumulation of data. And it's pretty important that they follow through on that, because the last time they made a big rate promise was back in 2020, when Governor Macklem said that Canadians could count on rates staying low for a long time. So basically everybody go out and borrow on the assumption that these rates are here to stay. And obviously he doesn't want to make that mistake again. So
Yeah.
I think the Bank of Canada is probably on pause for the rest of 2023, unless this banking crisis thing really blows up.
Okay, so we're going to wrap up with one question. It's going to be mine because I'm curious to pick your brain. So, I mean, one thing I talked about earlier, and it obviously has been in sort of a main topic, is this idea of distress among, either households or potentially even like over leveraged investors. And, there's been a lot of news about how we haven't seen that yet, in part because banks have been very, accommodating on variable rate mortgages, allowing negative amortizations and allowing long amortizations. But my question is, as people start to actually needs to renew their mortgage, right? Because you can't renew with a negative amortization, right? You can't renew with a 65-year amortization. So are we going to, do you think, I mean, again, this is all just speculative, but do you think we're going to start to see more people needing to exit? And maybe not, the average homeowner, but maybe the person who has, 2 or 3 investment properties, if they're renewing at 5.5% at 30 years. Like, are we going to see, do you think we'll start to see a little bit more distress as we move into the next year?
Absolutely. Absolutely. When those rate hikes take 2 years to exert their full impact, it's because mortgages don't come up for renewal the day after the Bank of Canada raises. So we need time for mortgages. 40% of all the mortgages in Canada are coming up for renewal by the end of 2024. So absolutely, John, we're going to see that impact hit the economy. I don't think it's going to lead to a foreclosure crisis. I don't think we're going to see a large swath of panic selling. The reality is the Canadians, all of the Canadians today that will be renewing in the next year and a half, or the vast majority of them, were qualified at a stress test rate that is very close to the rates that they'll be renewing at. And even the borrowers that are in a negative amortization position, I have borrowers in that scenario, and it's not like they're adding thousands and thousands of dollars every month to their mortgage. The negative am is it's I don't want to say it's for every borrower, but for most borrowers, they're adding $200 or $300 a month to their mortgage, and in many cases they have lots of equity. So there's no question. I don't want to minimize the stress it's causing people and the fact that it's not a happy situation, but Canadians pay their mortgages, and by and large, I don't think that's going to change. We will see cracks at the margin in the same way that Silicon Valley Bank was a weak bank that failed because higher rates are testing its strength, and it didn't pass the test. And there are probably going to be other banks, small ones, hopefully not the next month. Hopefully we spread it out. But higher rates are going to expose, as Warren Buffett said, when the tide goes out, we're going to find out who's been swimming without their trunks on. So in terms of Canadian mortgages, rental property investors who have multiple properties, no question. Those investors now are going from positive cap rates to negative cap rates, and they've got cash flow concerns. And the more properties they own, the more under strain they're going to be. No question. But I don't think they're a large percentage of the market. Mm-hmm. Also, you and I have talked about this many times. People who were putting deposits down on new construction condos who never intended to close on the condos, and were just hoping to use their deposits as a real estate play until completion, and they wanted to sell an assignment. As far as that goes, that's another area of weakness in the economy. We are going to see these cracks of weakness, no question. And there is going to be, I think, weakening at the margins. But is it going to creep into the center? Are we going to see a crash? Again, I hope I don't sound like a fool when I say this if you come back 2 years from now and play this video. But no, everything I'm seeing right now gives me confidence that it's going to be at the margins and not down the middle.
That's interesting. Yeah. And I think that is an important point. I think most people, reasonable people, I think, believe that we're going to see an increase in some distress. The question is it going to be such an overwhelming volume of distressed sales that it tanks the market? And I think, what you're saying, and I think most economists that I read, is that they're not expecting that. And it kind of makes sense, because I think most Homeowners are going to hold, like you said, most have a lot of equity. I think it's going to be on the margins. It's hard to say what volume, but yeah, so maybe we'll wrap up. For the non-rent investors in the market, do you think Canadians, we're going to last up, have enough savings to make lump sum payments to bring their amortization schedule in line? Would they even need to, or would they just, so that's a good question. So I guess the question is for households, when they're renewing, you know, and they need to kind of get their amortization, do they need to get their amortization schedule back in line, or can they just renew at 30 years? And what this, I guess what this person's asking just more specifically, just so I can unpack it for people. If I got a mortgage 5 years ago at a 25-year term and I'm supposed to renew today, I mean, in theory, I should be renewing at 20 years. I should be keeping my original amortization schedule, right? But if my payments weren't enough to cover the interest and my principal is balloon, in theory, my amortization schedule increase. So I guess this person's question is, do those people need to renew at 20 years, or will they be able to extend to soften the blow? And what I'm hearing is that it sounds like banks are allowing them to extend their amortization at renewal just to soften the payment shock, or am I wrong?
No, there's lots of flexibility. Banks are going to do what they can. They don't want to drive people into default who are making payments. And the longer the mortgage sticks around, the more profit they make. So in theory, if you re-extend an AM, you should have to requalify. You certainly do if you change lenders. Whether lenders have discretion to extend back up to original AMs, I suspect they do. Again, the banking regulator doesn't want to cause more stress than already exists in the market. And by the way, two more quick points, John. Number one, if you are a distressed borrower today and there's weakness at the margins, it's a strong market, right? Listings are low and stuff's getting snapped up. So the market can clear quickly for people who need to sell.
Yeah.
Number two, looking back historically, when it comes to mortgage repayment, higher interest rates don't cause major spikes in default. The big culprit when you see a spike in defaults, which leads to lots of foreclosure sales on the front lawn, would be job losses. And right now we have an unusually strong job market. So again, when we talk about the storm clouds on the horizon, they're on the perimeter, but you know, in terms of what's coming down the middle, with low amounts of listings, people who are distressed, able to sell quickly and clear. There was a funny story on Twitter. I forget who it was, probably somebody you know. The guy said that the private forced him to list his property for sale. And the guy had an offer night and he got 8 registered bids and an offer way over his list price. And then he said, I'm not selling. And he went and found another private lender and basically re-upped.
Oh my God, unbelievable.
So, you know, in a strong market where values are holding, there's a lot of flexibility that people have. And again, it's not that people aren't feeling stress, and it certainly will hit the economy. But are we talking a Florida type scenario from 2009 with foreclosure sales on every lawn? No, I mean, anything's possible, but that's a Mars hits Earth scenario. I don't see it happening.
That's awesome. David, thank you so much for your time this month again, and for answering everyone's questions. It was super helpful.
Thanks, John.
Thanks, man. Okay. Peter, I'm going to get you to jump on and join us. And we're going to wrap up just briefly today, chatting a little bit about the rental market. Peter Carlos, the broker or agent that works at our brokerage. Peter, maybe you can chat a little bit about some of the things that you're seeing on the ground in the rental market.
Absolutely. And thank you, John, for having me on. So from what I can see on the rental market is we're seeing a little bit more inventory than we did last year around this time. But even with that, the nice homes, the apartments and the condos that are listed for lease are moving quite quickly. The ones that we see remaining on the market are the ones that are not, not as nice, not as well kept, or we're seeing landlords that are demanding a little bit of a higher price than market value for their units. Having had a few conversations with some other listing agents in the area and about a few of their properties, I'm hearing that landlords are either waiting for the right tenant to come along. They're not in a rush to rent their unit, so they're okay to hold off for a little longer, or that their clients are expecting a higher than market price. And given what we've seen in rent, for example, from last year going into the holidays, prices bumped up a little bit because of the demand. So I'm thinking some of those landlords are expecting to receive a similar kind of amount.
Mm-hmm.
But again, on the other side of it, there are a lot of hurdles that I'm seeing when it comes to helping tenants finding the right place. And what are those hurdles? Well, some of those hurdles are having to find a reasonable home, condo, or apartment that has been well kept and clean. I'm seeing more of the less attractive units sit, of course, like I said. But you know, having helped out some of those clients and speaking to some others, a few of them reached out to me asking about rent control, looking to see what is available in older buildings so that they have that little sense of security from any increases or spikes. And of course, helping with family members that are looking to find something that's a little bit more affordable. Given the prices and given the areas that they're looking into, they want to make sure they're getting into a really great school district or an area that's close to community centers so that they have that access to programs and services as well as around parks, you know, so they can take their family out and have a nice weekend together. But those areas are in high demand from what I'm seeing. So it's making it a little bit difficult for families to find something a little bit reasonable in that area.
Mhm. That's
Uh,
awesome.
Sorry, go ahead.
Yeah, I was gonna say, so how do you finding things then? I mean, from a landlord's perspective, I mean, when you're representing them, kind of what are the things that you're seeing? So you mentioned that they're being a little bit stubborn on price, looking for the right tenants. So what are the things that you're kind of seeing in terms of offers that you're getting?
Really great question, John. So from the landlord side of things, we're seeing a high amount of interest from all kinds of applicants. However, landlords are a little bit weary about accepting something just based on a conversation with the applicants or the information that they're providing. And given how difficult it can be for landlords to go about the process of removing a less than convenient tenant, if you will, from their property and the potential of what that's going to imply. A lot of a lot of landlords are asking agents to do a pre-qualification check, if you will, and to conduct a more in-depth review of the information that is being provided to them, and to cross-reference that information with any other sources that we find. The other issue is that given the high amount of potential fraud that's out there, all these steps are being taken by the landlords to make sure that they're avoiding putting themselves at risk of inheriting that less than ideal tenant, just simply for fear of the time and effort needed to have them removed, right?
Mhm.
So I actually have an example, if you will. I was working with a landlord and we received an offer for a lease on a property that was listed. When I was going through my due diligence and reviewing all the information, right off the bat, I was able to see that there's a lot of discrepancies in their employee phone numbers, addresses, uh, and things like that. And you know, I did what I had to do. I jumped on there to double check the company itself, take a look at all the references, and make the phone calls as needed. Um, Long story short, what I ended up discovering was there were two different people posing as the same person for the company, and you know, one of them, when I called, said, you know, I'm a co-owner. I have so many people under my belt, and I'm currently driving to the office. I don't have the information that you're looking for. But who's the person that you're asking about? So I gave him the name, and he's like, oh yeah, this person. He's making this much. He's been working for us for this long. He does this type of job. He's this kind of person. And, you know, as great as that may sound, it's kind of a red flag when you just finished telling me that you're not going to be able to provide me that information up front.
Yeah.
And then, you know, same company, I called the main line to see if I can get, you know, the same information. And the person that picked up said, no, that person's actually a fraudster that's imposing to be the owner of this company. So, you know, you got to make sure you do all your checks and balances and try your best to protect the landlord, because at the end of the day, they're putting someone in their home, right?
Yeah.
The
I'm
sorry,
gonna
the other
touch.
the yeah,
I'm just
go
going
ahead.
to jump in and say that's super important, that we're seeing way more fraud on rental applications. And it's important, obviously, when you're representing a landlord to do all of this due diligence, because we're seeing it in sort of credit reports, we're seeing it in job letters, like so much fraud going on. So anyhow, that's super helpful. Peter, we're actually going to cut it a little bit short because I'm having computer issues and I don't want to kind of for my computer to crash
No worries.
mid-session. But thanks so much for joining us to chat about the rental market. Thank you everyone for joining us today. Feel free to post any comments you have in the chat or in the comment section. I'll try to answer them. Anything going on about the market. And as always, if you have any specific questions, you can always send me an email at askjohn@movesmartly.com. Thank you again.
Thank you.